Have you noticed that many people only come online to talk about the negatives of the Nigerian stock markets? They don't usually talk about the positives. They talk about the loss that maybe a relative made, maybe their parents made, or maybe their siblings. Forgetting that investing in the Nigerian stock markets is more than just picking stocks randomly based on random knowledge or hearsay or based on trend. You have to be intentional, you have to be deliberate when you are investing. And for instance, somebody who invested in Presco PLC, as at then, Presco was selling for 33 naira per share. So now imagine somebody who bought 100,000 units, which was 3.3 million naira then. Do you know that as at August 2025, that Presco that was selling for 33 naira per share then is now 1,480, which means your 3.3 million naira would have appreciated to 148 million naira. But you don't see this kind of narrative, you don't see this kind of examples online. Because if you were to be a land now, you will see people talk about the land they bought for 10 million naira that is now 40 million naira. Because many people are trying to sell to you, they want us to buy land. But nobody is selling this to you. Nobody is selling shares to you. People are making money in shares, they are making it silently. And it is only those that are even good that will tell their relatives that they are making crazy money in the Nigerian stock market. In 2025 alone, the Nigerian stock market has done so well. And you too can learn how to invest in the Nigerian stock market with precision. Even though you may not be that professional who knows how to check everything checkable, but at least to an extent you are sure of the stocks you are picking because your why is defined. You know your investment objective, you know the reason why you are picking a particular stock. And so I just gave this example so that you will see the potential in the Nigerian stock market. On this note, I welcome us to Nigerian stock markets for beginners. Now, it was Benjamin Franklin that said, an investment in knowledge pays the best interest. When it comes to investing, nothing will pay off more than educating yourself. So don't just pick stocks randomly. Know the reason why you are picking it. Know your objective. Know your why. It is very important. So invest in knowledge. This is the best interest. When you see people making money in the Nigerian stock market, it is because they are first of all invested in knowledge, or maybe they belong to like-minded groups where they rub minds together and they talk about the kind of stocks to buy. So they are not just picking stocks based on what content creators are saying, based on what people are just saying online, forgetting that at times they tell you when to buy, but they don't tell you when to sell, and eventually confused at the end rather than becoming better. So investment in knowledge pays the best interest. So try as much as possible, watch this course to the end. So let's go into it. So what do we have for us in this course? Number one is we'll talk about the potentials of shares and stocks investments. If you have been hearing about the downside, it is time you begin to hear about the potentials. The potentials. I can tell you that there are potentials in the Nigerian stock market. So in module 2, we are going to be looking at quality versus quantity. This is very important because this is a mistake that many beginners, even those who don't know about stock markets, that just want to put their money in stock market, this is one of the mistakes they make, and I'm going to analyze. Module 3, we look at some stocks explained. Then module 4, know your why. This is crucial. When you know your why, what and how becomes easy. So that is what we look at in module 4. Module 5, we look at why you should start investing now. Why you should start investing now. I'm sure you must have heard this quote. The best time to plant an oak tree was 20 years ago. The next best time is now. So the reason why you should start investing now, we'll talk about it in module 5. Module 6, avoid these common mistakes in the stock market. Common mistakes you need to avoid, just like I was talking about it at the beginning, that many only come out to push the negatives, the wrong narrative about the Nigerian stock market, because some of them made these common mistakes. I know that we have like 20 mistakes, but I'll just mention a few just to pick the ones that are cogent. Now, let's go ahead. Module 7, we look at various ways to start investing in the stock market. Various ways to start investing in the stock market. Then module 8, which is the last one, we go to what we call the 100,000 shares challenge. 100,000 shares challenge. Make sure you watch to the end because you are going to learn a lot. And I need to say this, there are even simpler ways. Even if you don't want to analyze, there are simpler ways, there are simple tools, there are made for you tools that you can pick stocks by yourself now. There are tools that has been made in such a way that you can go to those tools and you pick stocks based that suits your investment objective, and you know the reason why you are buying them. So just wait till the end as we dive into it. So you're welcome to Module 1. It is time to talk about the potentials and the downsides of the Nigerian stock market. I will not talk about the potentials. I will not tell you the potentials without telling you the downsides, because the truth is, as we have the green, we also have the reds. At times we have the bull market, which means the market is going up, and at times we have the market also coming down. Truly, people make losses, but losses can be minimized because it is entirely different from you gambling. Investing is entirely different from gambling, and there are solid ways you could actually invest in good stocks today. For instance, when I invested in ICO, and I was telling people invest in ICO, it wasn't as if maybe as a chartered accountant or a financial analyst I did the analysis myself. There is a done for you tool that you use where professionals, analysts, they recommend stocks, and it is done frequently where you can just go pick, and we also talk about that, even though it may not be in this beginner's course. But I'm just trying to tell you that there are potentials and there are downsides, and there are ways you could actually minimize the downsides so that you don't have losses, you don't have drawdowns. Let's go ahead and see the potentials before we talk about the downsides. Presco, as at April 2020, was selling for 33 naira, just like I said at the beginning. And if you bought 100,000 shares, then it means maybe at 3.3 million naira, it would have appreciated to 148 million naira today. Can you imagine that? What is the percentage gain? So, but you don't see this kind of narrative being pushed on social media. Many people are only talking about the downsides. But the truth is, it has a lot of upsides. It has a lot of potentials. And we still have many stocks today that are still at this rate, and they have good potentials. And that's why it is worth taking your time to know this matter. Just like Benjamin Franklin said, that the best investments is investments in knowledge. It is the investment that will give you the highest ROI. So let's go ahead. NACO, which is National Aviation Holding Company, was selling for 1.90 kobo as at April 2020. If you bought 1 million shares then at 1.9 million naira, that 1.9 at August 2025 will be worth 103 million naira. Can you imagine the percentage? So let's go ahead. Okomu also, as at April 2020, was selling for 55 naira per share. 100,000 units then would have been 5.5 million naira. And as at August 2025, it was selling for 1,020 naira, which would have giving you a whopping 102 million naira. Can you see the potentials? So that's the potentials. And as at today, as at the time, anytime you are watching this video, there are still stocks like this that are still in their growth phase. You only need to know how to spot them, or what are the analysts, what are they talking, what are they saying about them. And you can decide to go either route. Is either you go with the analyst or with what professionals are saying. I'm not talking about content creators now. I'm talking about those who work behind the scene, what they are saying, or you go and analyze yourself. And you can even decide to deploy both. Let's go ahead. So what are the downsides? The downside is that you need to be patient. If you see it as a downside, many people are not patient. They are not patient. They want get rich quick scheme. As much as there are potentials, you can see when we're talking about the upside, when we're talking about the potentials, it took 5 years. Do you know that some people would have bought at that 33 naira when the Presco was selling, and maybe when it got to 55 naira, or maybe it got to 60 naira, they came out? If it was their objective to invest for short term, or maybe just to quickly turn over that money, that's a different ballgame. But you see somebody who said, I want to invest for retirement, who wants to invest for long term, you have spotted a good stock, and just because, and you entered into it, and just because maybe at that point in time it was not doing well, you quickly sell. It's not supposed to be, and that's one of the things knowledge gives you. It gives you stability. It helps you to be stable in the market, not vacillate as the market also vacillates. Because one thing about the market is that you need to understand what we call volatility, which I will be talking about in the third point. Now, number 2 is that you need to know how to manage your emotions. A stock you bought, maybe you bought it at 55 naira, at times we come down to 45 naira, have a drawdown. We call it drawdown. For every impulse move, when we say impulse move, it means you see a stock that moves from this bottom, it comes up here, then you can see that there was a little replacement. That's what we call either a pullback or retracement or market correction. So, but you can see that it didn't come back to this downward. So when you enter here and you see some people, they bought at this up here and it came down here, but just because it was coming down, they quickly sell. You can see that when it now went up, it went above the price you bought it. These at times could take days, these at times could take weeks, these at times could take months. The question is, in these days, when the stocks is having a correction or a market pullback, would you be able to manage your emotions? Would you be able to manage your emotions? So you need to understand that this is key in investing, when investing in the stock market. No stock goes on a linear progression. No, there will always be an impulse move. This is what we call an impulse move, a straight move, then definitely a correction or what we call a market pullback before it continues its journey. So you just need to get acquainted with what we call managing your emotions. So as long as you can do this, you are patient, you can manage your emotions. And number 3, you ignore price volatility, which means price goes up today, tomorrow it may come down a little bit. It's similar to what I've mentioned, but ignore it. There are stocks you buy maybe at 100 naira per share, you see it may come down to 90 naira. You leave it, depending on your investment objective. And we are going to get there. Where we're talking about, you should know your why. When you know your why, this helps you in the market. It helps you. You are not agitated, you are not perturbed, because you understand. I hope you get my point. So learn how to ignore price volatility. If you have read the book Psychology of Money by Morgan Housel, you will understand that the price for the returns you are going to earn in the stock market is what we call the price of volatility. Market goes up and down. That's the way it behaves. But on a long run, if you are patient and you know how to manage your emotions, you are going to reap a ton of rewards. Let's go ahead into module 2. Now, let's talk about quality versus quantity. Now, I will give an example. When you have 1 million naira, for instance, you want to invest in the stock market, you see some people, they will not go and amass 20 stocks. But rather than going for 20 stocks just for 1 million naira, I would rather go with 5 solid stocks. So the reason why some people believe that it is a scam is that instead of buying, let's say 10,000 units of a particular stock, they bought 500 of this, they bought 200 of this, they bought 300 of this. This is more or less like gambling, random knowledge, random application of knowledge, because they do not know what they are doing. Let's just see this quote by Warren Buffett. He said, wide diversification is only required when investors do not understand what they are doing. The reason why you have decided to pick 20 stocks with just 1 million is because you don't know what you are doing. And that's the reason for this course. It is, we have the beginners, we have the intermediate, and we have the advanced. So it is not going to stop here. But we are talking about picking quality. Just imagine you have 5 stocks. One is, let's say you are at an average of 200,000 naira, and one does maybe 400%. Which means if just one should move 500%, you have recovered. You're already in profits. And in this day and time, I can tell you that out of those 5, if you pick those 5, at least looking at how the Nigerian stock market has behaved since 2020, at least 3 of them will be in profits, will be in over 100%. 3 minimum, if you have picked 5 good stocks. I don't want to say all the 5. But that is the goal. That is the key. Picking quality stocks, not quantity. At times you do portfolio review and you wonder what kind of thing is this. 1 million naira, you spread yourself too thin. It is called over-diversification. Over-diversification. It's more or less like you gambling. In my mother tongue, they say, if this one does not go, this one will go. No, that is the mindset of a gambler, of a speculator. When you are picking 5 quality stocks, even though you are not entirely sure of the ones that will do well, but you are predicting. There's a difference between prediction and speculation. Prediction is based on facts. Speculation is based on emotion, is based on your feelings, is based on what is trending. But when you go with stocks that are quality, 5 solid stocks, maybe the ones that have been analyzed by professionals, that is what you will be learning in the intermediate, while the advanced class we talk about how you yourself can analyze stocks, the tools to use. Also in the intermediate, you have the ones that have been done for you by analysts, and we have tools that we use for this analysis. So that is, it is better you go for 5 solid stocks quality than go for 20 solid stocks with just 1 million naira. If you have 20 million naira now, it's different. But with just 1 million naira, I will rather go with 5 solid stocks. So that's why you tell people just invest in knowledge first. Buy the cost. How much is the cost? 25,000 naira, 45,000 naira. To pick 5 solid stocks, they would rather prefer to take that 1 million naira and invest in the stocks, and eventually at the end of the year, maybe their 1 million naira would have become 1.1 million naira, and they wonder why is it like this. Meanwhile, if they have invested maybe 25 or 45,000 naira to buy the stock, to buy the course and invest it and take their time to study it, where they will be able to pick good stocks, and eventually at the end of the year their 1 million naira become 2, 3, 4 million naira. The potentials are unlimited when you know what you are doing. Let's go ahead. So just like I said, why diversification is only required when investors do not understand what they are doing. You should know what you are doing. Let's go ahead. Coach Benita says, know the stocks in your portfolio and know why they are there. This gives you confidence. Even when the stock market is bearish, when we say bearish, it means it's going down, you are confident. You know why? Because you know the stocks in your portfolio and you know the reason why they are there. I hope you get my points. Let's move ahead. Now, Module 3, shares and stocks explained. Shares and stocks explained. So what is a stock? A stock is a collection of shares in one or more companies. It's a collection of what? Of shares in one or more company, while a share is a single unit of ownership in a company. I hope you get that point. A share is just a unit. So when you say I own shares of a particular company, let's say I own the shares of MTN, I own the shares of Cement, the collection of all these shares is what we call stocks. Do you get that point? So if you buy 10 shares of Dangote Cement, it means you own a small part of Dangote Cement. 10 shares of Dangote Cement, you are an owner. You are a part owner. It means you own a company. It is only that you are not the one that owns it all by yourself, but you are a part owner of Dangote Cement. That's why we call them, they are called shareholders. They are shareholders. If you buy shares of GTCO, Dangote Cement, and MTN, you own a stock portfolio. So I hope you get the difference now. So let's go to common misconceptions about shares and stocks investments. What are the misconceptions? What are those points that have made people to be misled, or maybe the wrong narrative that has been spread in the news or in the social media? You need a lot of money to start investing. That's one misconception. It's a misconception, it's a myth. So many people think you must be rich before you can invest. No, the reality is you can start small. You can start with as little as 1,000 naira. 1,000 naira, yes, because there are penny stocks, let's say, that even sell less than 1 naira, less than 1 naira. So just imagine you invest 1,000 naira in such a stock and they can become something tomorrow. I hope you get it. So that is it. You don't need a lot of money. Your gain may not be that significant, but you know, if you put in, let's say, 1,000 naira and you put in, let's say, 10,000 naira, definitely if the market performs well, definitely the person who put in 10,000 naira will enjoy more, especially maybe they entered at the same point in time, they bought the same type of stocks, they bought the same at the same price. Definitely the person, if it is, let's say, 50% gain, the stock you bought at 1 naira now is now 1 naira 50 kobo. You both made 50% gain. The 10,000 naira would have appreciated to 15,000 naira, while the 1,000 naira would have appreciated to 1,500 naira. So the more money you put, the better. Nevertheless, that is not an excuse not to start saying until you become rich, you cannot start investing. You can start small. Number 2, stocks are just like gambling. I think I have explained this. It is not gambling. When you know what you are doing, it is not gambling. You are predicting the markets. It's not entirely different from gambling. I was once a gambler, so I know what I'm talking about. I was once a gambler, so I know that it is entirely different from investing. Gambling is a matter of pure chance, but this is not a matter of pure chance. You have selected solid stocks and you have checked their engine. When I say engine, it means you have checked their fundamentals. That's what we call engine of the car. An engine may look good on the outside, maybe a motorcycle, a tricycle, it may look good on the outside, but it takes a mechanic to tell you that no, the engine of this is faulty. And you don't have to be a mechanic for you to know that this car is faulty. Maybe by the time you begin to drive, you begin to feel that this car is not moving by the time you check the engine. So also you too, you may not go ahead, maybe spend 3 years to learn how to become a mechanical engineer or a technician. You just have to know the basics, how the car works, what is the engine, what are the components of the engine, and that is what the intermediate and the advanced course is for. So that you will not, when you don't know about a car, you are just looking at it from the outside and you say, yo, it is well painted, it looks good, maybe the name of the company is fine. It is not about the name of the company. It is not about the share price. It is about the engine. So when you know about the engine, you are not, that's why when some of us, when we want to go and buy a car, we take along who? We take along our mechanic. Why? Because he's an expert in what he does. He's an expert. But if you are so familiar, you are so conversant, you have used different types of car, experience would have set in that you yourself can know whether the engine of a car is good or not, because there are indicators to look out for. I hope you have explained that. I hope you get that. So it is not gambling when you know what you are doing. Now, so that is just the misconception. The reality is, with proper research, diversification, and patience, you are bound to get it right. At least 80% of the time, you are bound to get it right. That is it. Number 3, the stock market is only for experts or professionals. What a myth, what a misconception. Anyone can learn the basics of stock investing. Anyone, I mean anyone. You don't need to be a financial expert. You just need to know the basics. Just like when you hear the sound of an engine, you know that this engine is good. I hope you get my point. So that is it. So you don't need to be an expert. You only need to know what to look out for. And there are tools, there are websites today that they've done those calculations for you, what we call the ratio analysis, the financial analysis, the technical analysis, the sentiment analysis. They have done it for you. You only need to get there and just ride on the shoulders of those financial experts. You just need to ride on their shoulders. And that's one of the things we are even doing now. But if you want to take it further, then go for the intermediate and the advanced class. Or you can even decide to go for either of the two. At the end, I will explain the major difference between the two. So let's go ahead. You can get rich quickly. That's another misconception. Is it possible to get rich quickly from investing in the stock market? Absolutely yes. Is it certain? No. There's nobody that can tell you with utmost assurance, with 100% assurance that, within 10 years you are going to become a millionaire, because there are so many unforeseen circumstances that are beyond us. Microeconomic factors within the companies, within those stocks that you are buying, they are there. So you can't predict what will happen. It is only God that knows what will happen. But to a certain extent, we can say we are sure, if I pick this stock, looking at the rate at which they have performed, looking at their historical cost, looking at where they are now, I believe that by this time, this stock should have been this price. Historical performance does not necessarily tell us what will happen in the future. It's not a guarantee, I meant to say, of what will happen in the future. But at least to an extent, it tells us, it's a pointer to what is going to happen in the future. As much as we don't rely solely on it, but at least we allow it to guide us a bit in making informed decisions before we invest. So it is not a get-rich-quick scheme. Many beginners believe buying stocks will instantly make them millionaires. Absolutely not. In reality, building wealth through stocks takes time, patience, and consistency. Time, patience, and consistency. Let's move ahead. Misconception number 5. Only cheap stocks, penny stocks make you rich. That's a lie. Because when we talk about penny stocks, it means stocks that are below 10 naira, that are selling below 10 naira. And in the examples I made, it was only NACO that was 1 naira 90 kobo. In the case of Okomu, in the case of Presco was selling for 33 naira. Okomu was selling for 55 naira. So that's just to tell you that it is not only penny stocks that can make you rich. Many stocks can make you rich, especially those with solid fundamentals, with solid narrative. They can make you rich. People often chase low price stocks thinking they will multiply faster. Just before I came online, there are 2 particular stocks. One is going to be delisted. Another one does not have liquidity. And that's one of the things you'll also be learning in the advanced class, which is talking about liquidity. You need to check out for liquidity. And if you don't know what liquidity is, you can even search it out. So it is not just good to buy stocks. Let me just even explain it. Liquidity simply means how easy it is for you to sell that stock. Some stocks you buy them. For instance, as at the time of making this video, if you buy Geregu or let's say Seplat, it's hard to sell those stocks because they are not liquid. It is hard. Unlike the likes of ICO, unlike the likes of some other stocks, when you sell them, they are good to, you can easily sell them when you want to sell them. So let's move ahead. But a stock of 2 naira is not automatically cheaper than a 200 naira stock. It depends on the company's fundamentals, not the price tag. So which means a stock of 2 naira may be more expensive than the stock of 200 naira. So it is not by price. What will help us to know whether a company is cheap is what we call the price earning ratio or the PEG ratio. Those are in the advanced class. Now let's move ahead. All stocks are risky. That's a misconception. Not all stocks are risky. Not all stocks carry the same level of risk. Growth stocks is different from value stocks. Value stocks is different from defensive stocks. Defensive stock is different from blue chip stocks. Blue chip stocks is different from penny stocks. Penny stocks is different from cyclical stocks. So you need to know that we have different types of stocks and they do not carry the same type of risk. Blue chip stocks, for instance, it carries a different risk that is entirely different from dividend paying stocks. I hope you get my point. So that is that as regards misconception. Let's move to module 4. Know your why. This is crucial. Know your why. When you know your why, your how becomes easy and your what also becomes easy. Let's go ahead. An investor without investment objective is like a traveler without a destination. That is just the truth, anonymous. An investor without investment objectives is like a traveler without a destination. Now, let me give you the first perspective. Let's say Mr. Emeka, the first man, wants to invest for retirement. That is his own objective. Maybe he still has 30 years to go. Maybe he's currently at age 30 and is hoping to retire by age 60. So his plan is to invest for 30 years. So his own strategy will be entirely different from Mr. James. Mr. James wants to retire early. Let's also say Mr. James is 30 years. But Mr. James wants to retire by 45, which means Mr. James has a short clock. He has 15 years. So which means he needs to be strategic in picking his stocks. While Mr. Emeka could not really go in depth, maybe by the time he takes the intermediate class, by the time he begins to check those sites, those tools where stocks are being recommended by seasoned financial analysts, he can just begin to take those recommendations because he is going long time. But for somebody who intends to retire early, someone like me, I intend to retire early. Not because I don't want to work again, but I don't want to still be working all because of money. I want to work because I love what I'm doing, not because of money. Not necessarily going to work because I have to pay bills. Have you seen people at the age of 70 still having to drive taxis, still having to go to work? Why? Because they have bills to pay. They still have needs to be met. So Mr. James wants to retire early at the age of 45. So which means his own strategy will be entirely different from Mr. Emeka. Mr. Lanre, for instance, wants to invest for his children. He wants to invest for his children. And you know, when you are investing for your children, there are different stages. It may be maybe to fund their university. That is still investing for your children. It may be to give them a leverage in life. A leverage. Maybe by the time they become a graduate, they finish serving their fatherland, you want to hand over to them maybe, let's say, a sum of 100 million naira to get started in life, while you have been training them on how to run a business. But at that point in time, you want to give them a leverage. So that is the reason why Mr. Lanre is investing. So also his own strategy is entirely different. But that time also, he will want to teach his children this kind of thing. Definitely, he doesn't need random knowledge. He's been deliberate. In the case of Mr. Ahmed, the last man, he wants to invest for regular cash flow, which means Mr. Ahmed cannot be investing, let's say, in growth stock. He may be looking at dividend paying stocks. And when we talk about dividend paying stocks, he may have to look for stocks that pay dividend on a regular basis. And he may even want to now begin to invest in foreign stocks, because those ones even pay regularly than Nigerian stocks, even though we have some Nigerian stocks that pay regularly as well, but only a handful of them, only a few of them. So you can see that these four people, Mr. Emeka, Mr. James, Mr. Lanre, and Mr. Ahmed, they are investing for different reasons. So that's why you need to understand, know your why. Your why is different, is entirely different from your neighbor's why. Let's go ahead. Let's see the second perspective. Mr. Tunde wants to invest for wealth creation. He wants to create wealth. Why Mr. Chima wants to build wealth. There's a difference between creating it and building it. Creating it means right from the scratch. You are starting from level 0, which means you need to be intentional. While for Mr. Chima, at least there is a level of stability. He now wants to build it up. He wants to build on that level of stability. Then we have Mr. Jubril, who wants to invest for wealth preservation. Wealth preservation is entirely different, which means he already has maybe his active income generated him so much wealth. He wants to preserve the wealth. He doesn't want it to depreciate in value just by keeping it in the bank. So you can see that even these three that I've mentioned, Mr. Chima, Mr. Tunde, and Mr. Jubril, they have different reasons for investing. That is why you need to know your why. Then we have the like of Mr. Cosmos, who wants to invest for wealth retention. The reason why he's investing is for his children, for his grandchildren, is to retain wealth, not to preserve it again, not for wealth building, but for wealth retention. So I hope you get it. So please, it is imperative that you know your why. Let's move ahead to module 5. Why you should start investing now. Just like the quote I gave you at the beginning, that the best time to plant an oak tree was 20 years ago. The next best time is now. Why should you start investing now? If you look at this is what we call the cash flow quadrant by Robert Kiyosaki. Cash flow quadrant, the author of Rich Dad, Poor Dad. And he wrote this book, fantastic book, Cash Flow Quadrant. If you can lay your hands on it, you can read it. Now if you look at the left side, which is the E and the S side, that side gives you what we call financial stability, which means it's either you are an employee or you are self-employed. And this side, which is the E and the S side, takes something from you. It is called time, effort, and energy. Which means if you don't put in your time, you cannot make money. If you don't put in effort, you cannot make money. If you don't put in your energy, whether physical energy, whether it is mental energy, if you don't put in one type of energy, you cannot make money. Now, remember that a time will come when it's either you resign or you retire. Because a time will come when the things you are doing now, the effort you are putting in it, the energy you are putting in it, you will not be able to put in those energy again because you are becoming old. And that's why you need to start investing for the future. Start thinking of the future, building a system. Either you build a system or you become an investor when you own a business. Some people call themselves a business owner, but in actual fact, they are what we call self-employed. Because without them going to that business cannot run without them. That is what we usually call sole proprietorship. And many business owners are like that. The business cannot run without them. How you get to know this is that, can you leave your business for 9 days without being in that business, and you are sure that that business will make money and it will not collapse before you come back? And that's why you see that business owners will have to be at the place of business just because they know that the business cannot survive without them. So if you are in such category, you need to consider investing or building a system around that business that in such a way that it can run without you. So by the time you get to old age, you can relax and enjoy the fruit of your labor. And if you know you cannot build a system looking at the way where you are is, maybe you look at the system, you know that people are not trustworthy, you can't build a system on them, then become an investor. That is the easiest route. That is the route I choose, to become an investor. And what you need is knowledge and money. Your money begins to work for you. You invest in knowledge. When you invest in knowledge, it means webinars, pay for seminars, pay for courses, relate with like minds, go for one-on-one coaching. You invest in knowledge and you invest your money in a vehicle like stocks, where it gives you predictable streams of cash flow at the end. I hope you understand. So that is why you should start investing now. A time comes when it's either you retire or you resign, but your energy will no longer be able to do what it's doing today, and the earlier the better. Let's go ahead. Module 6. What are we talking about in Module 6? Common mistakes to avoid in the stock market. So what is mistake number 1? Investing without knowledge. Don't buy shares just because they are trending online. I remember I was watching a content creator who said they should buy a particular stock, and that particular stock, when it was selling at that price, I remember that was when I was telling the people that took the advanced class, because we usually have a WhatsApp group for them. I said, if you are in ICO, it is time to get out. They've already made over 100%, going to 200% then. That was the point that content creator was telling me to buy that particular stock. When I was saying, exit now, because this is going to go down. And I can tell you, as at the time of making this video, that very stock has gone down. I think from around 4 naira 60 kobo, it has gone down to 3 naira plus. So can you imagine? So don't just invest. And some people bought, and I remember I was reviewing the portfolio of somebody, I saw that maybe it was that content creator you followed to buy that stock because it was now in loss. So please invest with knowledge. That's why, as much as possible, if you cannot take course 2 points called the advanced class, take the intermediate class. The intermediate class will expose you to the sites where analysts, not just one, it's at least 2 sites, 2 tools where analysts has done the homework for you, and you just have to follow what they are saying. And I can say it at times, one of the lazy ways I invest is by going to those sites. One of the lazy ways, or just to corroborate my own analysis. I want to see what they are saying about that stock. So after I've done my own analysis, I just want to relate my own analysis with what they have done, and I go to those sites. So don't invest without knowledge. Don't buy shares just because they are trending online. You need to know your entry and your exit strategies. All this you will learn in the intermediate and advanced course, talking about entry, exits, what at what point should you enter. They tell you when to buy, they don't tell you when to sell. Some stocks are good, not for the foreseeable future, not for 20 years, not for 25 years. They are just good maybe for 3 years, they are just good for 2 years, they are just good for 1 year. That's why it is good. We also talk about reviewing your portfolio once in a while, maybe at least quarterly or once in a month, depending on how busy you are or how free you are. Let's go ahead. Chasing quick profits. I've spoken a bit about this in the misconception. Stock market is not for urgent money, it's for patient money. I say that again. Stock market is not for urgent money, it is for patient money. Don't bring short-term money into long-term investment vehicle. Stocks is a long-term vehicle, so don't bring in short-term money. I hope you get that. So it is the money you are going to be using for your house rent. Don't quickly bring it into stock markets. You don't know what will happen in that cycle. You don't know whether the market is about to go bearish. I hope you get my point. The stock market is not a get-rich-quick scheme. Number 3 is following the crowd. We call it the herd mentality. Just because people are doing it, you also want to do it. Please don't do that. It's a common mistake. What stocks are people buying now? You too, you go and buy it. That's one of the reasons I don't also recommend stocks. I do it once in a while, but definitely I will make my explanation. This is the reason. At this point in time, I think you should come out. So not every time, because at that point in time when I'm making stock recommendation, I have a 25-year-old guy that is watching the content. I also have a 56-year-old man that is watching the content. Absolutely, they should not go for the same stocks. They should go for different stocks. Let's go ahead. The last but not the least mistake, just like I said, we have like 20, but let me just mention 4. Failing to educate themselves continuously. You need to know that the markets change, the dynamics change, markets evolve, they are not stagnant, things change. An industry that is thriving today may tomorrow become obsolete, maybe due to technology. A stock that is performing well today, maybe due to a management decision, could make the stock to begin to nosedive. So you need to stay informed, and that's why follow market reports daily. When you go for the intermediate course or the expert course, definitely you will see where you can get report daily. And even if you are now in the take course for the advanced course, you can eventually join our private WhatsApp group. Attend webinars, gain insight from experts. We usually have webinar from time to time, depending on what the market is saying, just to get our people informed. I just made a video, for instance, yesterday where I spoke about the new tax law, how it affects people who are investing in stock. And I'm also still going to make a webinar where I'll be talking about how the tax law, the sectors is going to affect. What are those sectors that is going to benefit from this tax law? So let's go ahead. Read earnings releases. You need to know how to read that as well, at least once in a while. Take courses, refresh your knowledge. The reason why some people are still pushing the negative narrative is that they refuse to refresh their knowledge. It is what they know yesterday that they think is sufficient today. Meanwhile, the dynamics has changed, the narratives have changed. There are nuances that have really changed. I hope you understand. Knowledge empowers better investment decision. You need to understand that. Maximizing the stock market. So the question is, how do you maximize the stock market? How do you maximize it? When we talk about equity investment, there are 2 major ways you can invest in equity investment. That is shares and stocks. When you hear equity, it also means shares and stocks. So you can have a basket of stocks, which is this side, the blue here. So you can have this where you invest in equity mutual funds or exchange traded funds, which we call ETFs. So they are basket of stocks. Those stocks were chosen for you. You don't even know what is in those baskets at times. For instance, you can decide to go for United Capital equity mutual funds. Equity mutual funds, they invest in shares and stocks, but you don't know the stocks they have invested in. So you can decide to go for that, and whatever return comes to you, that is what you pick. So that is the simpler route or the simplest truth of investing in shares and stocks. So if you know you are not ready for all this stock analysis, okay, you have heard that don't just take stock recommendation online randomly, don't go by random knowledge, and you are not ready to go for the second side, which I'll be talking about, the individual stocks. Just go for equity mutual funds, or you go for exchange traded funds. And please, you can check the website CIF Academy. You will see the courses on this day. You will see a particular course on mutual funds, because we have over 8 mutual funds, different mutual funds. We have the likes of balanced mutual funds, we have the like of specialized mutual funds, we have money market fund, we have Sharia compliant mutual funds. So we have them like that. You need to understand that. And we have equity mutual funds. So I spoke about equity mutual funds in mutual funds course. So you can get it. And exchange traded funds, which is ETFs. We have 13 currently in Nigeria, and we also have the foreign one. The foreign one, we have over 3,400 exchange traded funds in the US, for instance. So the cost, they will be together, both Nigerian ETFs and foreign ETFs. You can also go for that. So any of the two, if that is the simplest way. If you now decide to go through the second route, which is picking individual stocks, the first route is going by a basket of stocks which is already picked for you, and you don't even know the content. Some you may know, some you may not know. Now, you can go for individual stocks where you pick stocks by yourself. Now, there are two ways you can pick these stocks in your home portfolio where you are tracking it by yourself. It's either you go for stock recommendation by professionals. When I say professionals, I don't mean content creators. I mean those who are in the game. I mean those who are in the markets, what they do is stock analysis. So you can go for that. So when you want to go for that, you go for the intermediate course. And the second route is going for personal analysis, where you do the analysis by yourself. That is the advanced course. So the first one is stock recommendation. When you want to pick individual stocks for yourself, you go for the intermediate course. You'll be introduced to two sites where professionals do stock recommendation frequently at intervals. So you can go there, pick it. Just like I said, when I picked AICO, I did not pick AICO based on personal analysis. I picked it based on one of these two, and it did over 100% within a short period of time, even before the NAIRA Act was signed at all. Before the NAIRA Act was signed. So it was not the fundamentals that even drove me recommending AICO. It was because I saw it being recommended by like-minded professionals, professional analysts. That's what made me pick, because at times even me, I don't have the time because I do other things. So I just decided to buy and also recommend, and it was a good buy. Eventually it did over close to 200%. I told people it is time to sell off because there will suddenly be a retracement. Then the second one is personal analysis, where you have to go for the advanced course. The advanced course is where you learn the fundamental analysis, technical analysis, the basis, at least the things you are supposed to do. And the advanced course also comes with portfolio review by me. I will review your portfolio. Maybe after picking your stocks, we do a portfolio. I'll give you a questionnaire that you answer that will help me to know the kind of investor you are. I know nobody knows it all. We talk about having like minds conversation. So we just have that conversation, and you also be added to a WhatsApp group where you can ask any question on stocks and shares, Nigerian stocks and shares. You are welcome to the last module, which is module 8, the 100,000 shares challenge. 100,000 shares challenge. What does this mean? It means, just like we said at the beginning, that the likes of Okomo was selling for 55 naira, the likes of Presco was selling for 33 naira per share. And people who bought 100,000 shares then, they are millionaires now, because that 3.3 million naira they bought 100 units of Presco with is now 148 million naira. So also you look for 100,000 shares of a particular stocks that you want to buy, and just buy 100,000. So it is called the 100,000 shares challenge. And leave it for the next 5 to 10 years. Leave it for the fact that you are going to live for the next 5 to 10 years. This kind of stock is not any stock you pick randomly, maybe by random knowledge. It is either it is recommended by a professional, or maybe you have done your analysis and you can see that, no, this stock is what I'm buying for my 100,000 shares challenge, and see what it becomes in the next 5 to 10 years. If you pick any stock, it may not work for this challenge. So that's why I said go for the intermediate course or the advanced course. The question is, how do you get the intermediate course or the advanced course? You can either chat me up on this number, which is 080-8100-8686, or you go through this route, which is go through our website, www.cifacademy.com.ng. You see the course there, you see the account number in which you are to pay the said amounts, then you send a proof of payments to 81008686. And also, you can check other courses that we have on the website, as you are going to benefit a lot from them. Don't forget, the best investment you can ever make is in knowledge. It is that knowledge that will now help you to maximize return in whichever assets you are investing your money. Thank you so much for staying to the end. So we meet in either the intermediate class or the advanced class, or whichever course you decide to now go for. Stay blessed. Thank you.